8%, with silver trading near $73 an ounce and gold near $45.15. Those are not ordinary numbers. Those are the kind of moves that usually take months to build, not a single settlement cycle to print. The time compression was the real shock. Not months, not weeks. In what felt like 48 hours, the market flipped from celebrating record highs to forcing liquidations, margin calls, and the kind of selling that spreads from one desk to the next. The reason this matters is not because red candles are scary. It matters because just days earlier, gold had pushed through $5,000 an ounce, with reports of a peak near $500, and headlines were treating that level like a new permanent reality. They said this kind of reversal could never happen without a war, a default, or a systemic failure. Then it happened anyway. That is the definition of a stress test, and the metals market just failed one in public. Here's the uncomfortable part. Large institutions already saw the fragility building. They can see positioning, liquidity, and leverage long before it shows up in the trending topics. By the time the crowd is emotionally certain, the structure is often already unstable. That's why this episode is bigger than a single day. It's a fork in the road. If the market stabilizes, metals can rebound fast because forced selling leaves an air pocket that fills quickly. If it breaks, it gets ugly because the same leverage that powered the rise can power the unwind. What I'm about to lay out changes how this move looks. Not as a mystery and not as a prophecy, but as a pattern you can recognize in real time if you know where to look. Welcome to Signal Vault. This channel is built for people who want the wiring diagram, not the noise. We decode what matters before it becomes mainstream conversation, using market structure, history, and numbers that are hiding in plain sight. If that's the kind of analysis you value, stay with me and drop a quick comment with where you're watching from, because metals trade around the clock and this community does too. Now let's reconstruct what happened, because the timeline is the first clue. The run into the peak was not a gentle grind. In January, gold didn't simply rise, it surged through major levels and then crossed $5,000 an ounce. That kind of move pulls demand forward from the future. It attracts momentum funds, short-dated option buyers, and late money that is less committed to the long-term rationale and more committed to the next candle. Silver followed, as it usually does, but with more torque. Silver is a thinner market with a wider emotional range, and it tends to exaggerate whatever gold is doing. Then came the snap. On February 2nd, the narrative in markets shifted hard toward expectations of tighter policy and a different leadership path at the Federal Reserve, tied to a widely discussed nomination story. Whether that was the fundamental cause or merely the trigger is the question that matters. If a single shift in expectations can erase a historic run in days, it means the market was not just pricing fundamentals. It was pricing positioning, leverage, and crowded consensus. A 7+% down day in gold is rare. A double-digit down day in silver is the kind of move that forces selling for reasons that have nothing to do with conviction. It forces selling because cash is demanded, and when cash is demanded, traders sell what they can, not what they want. That distinction is everything. Most public narratives treat price as a vote. In reality, price is often a liquidation. Here's where it gets interesting. The metals market had quietly shifted its buyer base before the crash. A major pillar of the bullish story has been central bank accumulation, because official buyers tend to move slowly and think strategically. 3 tons, down around 20% from the prior year. At the same time, investment demand surged to roughly 2,175 tons, up about 84%. That is a massive flip in who is driving the marginal price. When slow hands dominate, pullbacks tend to be measured. When fast hands dominate, pullbacks can become avalanches, because fast money uses leverage and fast money exits quickly when the story shakes. That doesn't mean the long-term logic disappears. It means the path becomes dangerous. This is not the first time this skeleton has appeared. In late 1979 and early 1980, precious metals went vertical as inflation anxiety and geopolitical tension pushed people into hard assets. Silver, in particular, became the symbol of that era's frenzy. The reversal was not gentle. It was accelerated by margin dynamics and sudden shifts in exchange rules that forced liquidation into a falling market. The details of that era are unique, but the structure is recognizable. A parabolic rise, crowded positioning, then a violent unwind that punished leverage. In 2011, gold climbed to record territory amid post-crisis uncertainty and extraordinary monetary policy. The story felt inevitable. Again, the pattern wasn't that gold became irrelevant. It was that the marginal buyer changed, and the market had to reprice risk under different conditions. In 2020, during the global liquidity shock, gold spiked and then behaved in a way that confused casual observers. It was treated as safety one day and as a source of liquidity the next. That is a concept worth holding tightly. In moments of stress, even safe assets can be sold because survival is about liquidity, not ideology. The sharpest drops often occur when an asset is widely owned, highly liquid, and used to raise cash fast. Bring that lens to 2026, and the February snap looks less like a random surprise and more like a mechanical reveal. The market proved it can move violently right now, and that alone changes behavior. Risk managers tighten. Position sizing shrinks. Haircuts increase. Volatility can become self-reinforcing because participants trade smaller and thinner liquidity amplifies moves. So where do institutions fit into this? Not in speeches, but in structure. Start with the venues. Most of the price the world watches is formed through a web of futures, options, spot dealing, and exchange-traded funds, stitched together by arbitrage. On the futures side, the COMEX gold contract is typically 100 troy ounces. At roughly 4,215, that's about $451 notional per contract. 8% move is roughly $217 of variation margin swinging in a single day on one contract. For silver, a standard COMEX contract is 5,000 ounces. A 4% move is roughly $560 of variation margin. Those are not abstract numbers. That is cash that must be posted today or positions get reduced. Now layer on options. Options don't just reflect fear. They can manufacture it mechanically through hedging. When a market rallies sharply, dealers can end up short call gamma. When price then reverses, hedging flows can flip from buying strength to selling weakness, amplifying the move. That is why you sometimes see a break that accelerates without any new information. The information was positioning, and the move was the unwind. Then consider the intermediaries. Bullion banks and large dealers make markets between miners, refiners, manufacturers, ETFs, and institutions. Their job is to provide liquidity, but liquidity is not a charity. When volatility explodes, the cost of liquidity rises and the willingness to warehouse risk falls. Spreads widen. Depth disappears. The market becomes more sensitive to each order, and that sensitivity makes the next margin call more likely. ETFs add another layer. When investors pour money into a metal ETF, it can translate into physical demand through the creation process. When they pull money out, it can translate into supply through redemptions. Those flows can be steady, or they can become stampedes, depending on sentiment. In a market where investment demand is already dominating, ETF flows become a lever that can push the short-term price far away from the slow-moving fundamentals. Finally, there is the physical ecosystem. Refiners that turn raw material into deliverable bars, vault operators that store and transfer them, and the over-the-counter market that clears large trades. When everything is calm, the paper market and physical market remain tightly linked by arbitrage. When stress appears, that link weakens, and the gap becomes the story. This is the part no one wants to admit. Metals are two markets wearing one price tag. There is the paper market, where futures and options change hands at machine speed. And there is the physical market, where bars move through refineries, across borders, and into vaults. When confidence is high, those markets appear synchronized. When confidence cracks, they diverge, and the divergence becomes the real signal. To see how strange that can get, look at the scale of reported vault holdings. As of late December 2025, London Vault data showed about 9,106 tons of gold in the system, and around 27,818 tons of silver. On the surface, that looks like abundance. So why did price behave like scarcity on the way up and panic on the way down? Because metal in vaults is not the same as metal for sale, and because paper claims can expand and contract far faster than the physical supply chain can respond. A vault number is an inventory snapshot. A price crash is a flow event. When flows are dominated by leveraged traders, a flow event can overwhelm the pricing mechanism even if inventories look large. That is exactly how dislocations are born. Dislocations can appear geographically too. Different exchanges operate under different rules, different margin frameworks, and different retail participation. In recent episodes, local contracts have printed extreme daily moves, including sudden drops around 25% in a single day on certain venues after sharp runs. Those moves are not proof of shortage or surplus by themselves. They are proof of leverage interacting with rules. They tell you where stress concentrates when the system is stretched. So what created the February conditions? Think of it as a chain. First, a rapid rally to a major psychological number created a crowded trade. 5,000 is not just a price. It is a billboard. It invites late momentum. It invites options activity. It invites the kind of this time is different confidence that makes risk management lazy. Second, the buyer base tilted toward investment flows. And investment flows are more sensitive to rates, volatility, and risk sentiment. Central banks do not usually panic on a Tuesday. Momentum funds do. Third, leverage was present. Leverage is not evil. It is a tool. But in a crowded environment, leverage turns normal moves into forced moves. That's how a pullback becomes a waterfall. Then came the trigger, a rapid shift in expectations around policy and leadership. Markets trade expectations, not reality. When expectations shift, Portfolios rebalance, hedges adjust, and the weakest hands are tested immediately. Here's where it gets even more interesting. Near major highs, the market becomes a lattice of competing positions. There are longs who need continuation, shorts who fade too far too fast, option dealers who hedge dynamically, and systematic funds that rebalance mechanically. Price becomes less about a single narrative and more about who is forced to act next. That is why a chart can look calm right up to the moment it collapses. Now add margin, the quiet governor of futures markets. When volatility rises, exchanges and brokers often increase margin requirements. When margin requirements rise, leveraged participants must post more cash. If they cannot, they reduce positions. Reducing positions means selling into weakness, which increases volatility, which can lead to more margin pressure. It's a feedback loop. The exits do not change, but behavior does. The stampede becomes the story. Because once forced selling begins, the market does not care about your thesis. It cares about collateral. So what does holds actually mean? It means the market finds a level where forced selling exhausts itself. It means volume spikes, then calms. It means candles stop extending lower on bad news. It means the market can absorb selling without cascading. When that happens, rebounds can be sharp, not because the future is guaranteed, but because the selling was mechanical and the positioning was cleansed. And what does breaks mean? It means support fails and then fails again. It means selling is not just liquidation, but a shift in conviction and risk appetite. It means rallies become fragile and are sold quickly. It means the market spends time rebuilding trust, and time can be the most painful part. To differentiate between the two, the best tool is not a prediction, it's a checklist. Watch whether gold stabilizes after the shock. Stabilization is not an immediate new high. It is reduced range, fewer gap down opens, and evidence that sellers are no longer in control of every session. A market that refuses to make new lows on repeated negative catalysts is a market where forced sellers may be gone. Watch silver's relationship to gold. Silver exaggerates both directions. When silver collapses far more than gold, it often signals deleveraging. If silver begins to stabilize and outperform on up days, it can signal stress is easing. If silver continues to underperform violently, it can signal the deleveraging is not finished. Watch the dollar and real yields, but don't treat them like a single switch. Look for correlation breaks. Days when yields rise and gold rises too, or days when the dollar weakens and gold still falls. Those are the days that reveal what is actually driving price. If correlations become unstable, it often means internal positioning is dominating macro logic. Then watch for physical signals. You don't need access to every vault ledger. Physical stress tends to leak through premiums, delivery behavior, and shifts in flow between hubs. The paper market can detach for a time, but if the physical market pushes back, the gap cannot persist indefinitely. Either paper snaps back toward physical reality or physical behavior changes to match paper pricing. Another signal sits in the shape of the futures curve. In a calm market, the curve is usually a gentle carry trade. Later months priced a bit above spot to reflect financing, insurance, and storage. In stress, that shape can distort. If nearby contracts trade unusually rich relative to later months, it can suggest a scramble for immediate hedges or immediate deliverable supply. If the curve steepens the other way, it can suggest that financing is tightening and participants are paying up to push risk forward in time. Related to that is the cost of borrowing metal, often discussed through lease rates in the wholesale market. When the system is loose, borrowing costs are quiet. When the system is strained, borrowing costs can jump. And that change often shows up before the chart calms down because it hits the plumbing first. Geography matters too. Gold and silver don't trade as a single pool. They trade as connected hubs. When prices in one hub persistently trade above another, it hints at where physical demand is pulling and where supply is stuck. Watch for reports about refineries running at capacity, about unusual shipping flows, and about regional premiums that refuse to normalize even when the screen price drops. Then there are the vehicles that translate sentiment into flow. ETF creations and redemptions can turn investor mood into physical movement, and they often speed up right after a volatility shock. On the exchange side, warehouse categories and delivery behavior can hint at whether participants prefer cash settlement, rolling positions, or taking metal. None of these signals is magic by itself, but together they tell you whether the system is relaxing or tightening. And finally, pay attention to the paper bridge between futures and spot, often expressed through short-term spreads in exchange for physical activity. When that bridge is stable, arbitrage keeps the system tight. When it wobbles, participants demand more compensation to take the other side. That is how liquidity disappears right before the public notices, and it is why sudden sell-offs can look like the market broke overnight. And don't ignore the official sector. Even with annual central bank buying lower than the prior year, strategic accumulation remains a feature of the modern market. The fact that a single country like Poland was reported to have added about 102 tons in 2025 tells you that some institutions are still thinking in reserves and decades, not in candles and days. That slow bid can matter after the fast money has been washed out. This creates the central contradiction of the moment. On one side, an investment-driven rally can unwind violently because investment flows are reversible. On the other side, the longer-term rationale for owning reserve assets can remain intact in a world where currency confidence, debt dynamics, and geopolitical risk continue to be tested. The market is trying to reconcile those truths in real time, and that reconciliation process is what creates volatility. Let me put the dislocation in everyday language. Imagine two thermometers in the same room. One reacts instantly to a gust of cold air from an open door. The other is slow, but it reflects the true temperature of the room over time. In metals, paper prices can react like the fast thermometer. Physical behavior is slower, but it reflects actual supply chain reality. When the gust passes, the fast thermometer can snap back. But if the room truly changed, the slow thermometer eventually catches up, and that's when a trend becomes durable. The February crash was a gust powerful enough to knock the fast thermometer off the wall. The next phase will tell us whether it was only a gust or whether the room itself changed. If it was primarily a leverage purge, the path forward often includes a fast rebound, followed by a period of rebuilding. In that scenario, sharp rallies can emerge as shorts cover and liquidity returns, especially if the macro backdrop remains supportive. If it was a regime shift, the path forward often includes choppy rebounds that fail, persistent volatility, and a deeper reset where the market searches for a new equilibrium. That is what ugly looks like in markets. Not a single dramatic moment, but a drawn-out process where each bounce is tested and each test matters. There are also intermediate outcomes. The market can rebound partially and then enter a wide range for months, digesting the blow-off and allowing the buyer base to rotate from hot money to steadier hands. That outcome is common after a milestone break like $5,000, because the market has to decide whether that level was a breakout or a climax. So the focus should be on signals, not slogans. Is volatility calming or staying elevated? Are down days shrinking in range or expanding? Is silver finding its footing or continuing to lead lower? Are correlations with rates and the dollar stabilizing or fracturing? Are physical indicators quiet or showing strain? And here's the most important point about the divide between participants. The difference is not intelligence. It is attention. The crowd tends to react to price after it moves. Institutions focus on structure before it moves. They watch where leverage is concentrated, where liquidity is thin, and where margin dynamics can force behavior. They do not need to be right about the long-term story to understand the short-term mechanics. They only need to be earlier than the forced sellers. That is why information becomes wealth. Not because information is secret, but because most people ignore it until it becomes obvious. By then, the best part of the move is often over, and the worst part can be beginning. So when the title says, if this holds, metals rebound fast, and if it breaks, it gets ugly, it is not a threat. It is a description of how leveraged markets behave after a historic sprint and a violent snap. Stability returns quickly after mechanical selling, or instability feeds on itself when key levels fail and risk is reduced across portfolios. This moment is a test of the market's plumbing. The numbers already told us that. $5,000 gold, then roughly 4,115s. Silver surging, then falling toward $73 in a single session. Those are not normal prints, they are signals. Signal Vault exists to read those signals before they are packaged into simple stories. If this connected dots you hadn't seen, you know what to do. And the question isn't whether metals will move again. The question is whether the next move is driven by stability returning or by the plumbing breaking further before the crowd even realizes what it's looking at.